Honestly, it's not as bad as I thought. I mean, fuck, it's not good, but $16,450, give or take a couple of cents on top, is what we lost last year in 2022, just strictly on options. I happened to stumble across my Webull P&L, and they can break it down by options, by stocks, by this, by that. And that was the number that it spit out when I went from January 1st, 2022 to December 31st, 2022, down $16,450. Yikes. So that got me thinking, did I actually learn anything from last year, or am I just an idiot who doesn't learn from his mistakes?
3, 2, 1.
So I thought it over, and I have good and I have bad news. And I'm just gonna give you the bad news first because we'll get to the good stuff later on. Okay, so the bad news, I repeat, I did not mutate into some social media trading savior in a span of 3 months as I make this video in March of 2023. And no, unfortunately, I do not have a $100 a month or even more alert service that I can sell to you. So if you're looking for that, those two things, unfortunately, I have to give you the bad news. This is not the right place for you. And maybe you can find somebody else. There's actually a lot of people out there who offer those things, or at least claim to offer those things. And I'm sure you can find somebody else. It's not right here. The good news. So I was able to take that $16,000 or so, give or take, loss and boil it down to 3 lessons, 3 of the most important things that I've been able to take away from 2022. Now, past me would probably greatly appreciate these 3 things, and maybe it would have gotten me down from around $16,000 to maybe $15,000 in losses. Woo! No, seriously, maybe $14,000. I mean, what's the saying? You gotta live and learn, right? So that's part of the game, I think, right? At the end of the day, like, yes, could past me have come back, or could future me have come in to past me and be like, hey, man, that did not sound right. But could future me told past me these things? Would I have been able to save some money? Maybe a little bit. But at the end of the day, I probably would have lost a decent amount of money, because there's a part of this game that is a live and learn, and you kind of have to figure it out on your own. Because people can tell you all these different things, and you can watch videos and you can learn from this person, from that mentor, all this stuff. But a lot of times, you kind of got to put your own money on the line. Sometimes you can say paper money will be able to way to learn, but I don't know. I think that real money is the best way to honestly learn when it truly comes down to it. So yes, could I have potentially saved a little bit of money? Sure. The point of this video is to expand upon these 3 lessons to help you in the future. And of course, is it something that I think is going to save somebody from making the same mistakes and losing the same amount of money? No, but if it can make you lose a little bit less, or at least cut the learning curve a little bit better, you know, get you there a little faster to kind of figure that out, like you're going to be on the right path to whatever that is, whether that's to get you, you know, through this phase and into just something else because it's a phase and you want to move on from the market, or to get you into a different style, a different strategy. It doesn't matter. Like, the whole point is to kind of take something away. And for those who've been kind of maybe even watching over that past span, this should be a really good summary of what not to fucking do again for myself. Okay, so into the 3 lessons. Now, number 3 is, I think, the most important. It kind of like takes the first 2, wraps them up into a beautiful bundle, and says, this is where I'm going from here based off those mistakes. And so I think it's a good kind of final piece. But number one, averaging down is a dangerous game. What do I mean by that? And so I want to go through an example of a stock and a chart for, you know, really that I was kind of honed in on in 2022. Okay, a lot of things kind of play into this game, and I will mention that part of this also has to do with giving a fuck about where the market goes, because in the honest, like, grand scheme reality, if you're like trying to trade, like, you shouldn't give a literal fuck where we go, right? Your long-term portfolio does kind of care, right? And like, you should be positioned in long-term stuff that, like, to be honest, doesn't necessarily matter. Like, you shouldn't have to worry about a stock going bankrupt, right? Or a company going bankrupt in a long-term portfolio. Like, that's, at least in my opinion, right? This way you don't have to worry about it as much. In a more actively managed shorter-term portfolio, maybe you could play those stocks, but you're playing off the shorter-term price action, so you're taking advantage of setups or strategies or things that are going on in volatility, right? But like, that's kind of like one of the bigger pieces. But when it comes down to averaging down, like you kind of frame yourself into this, like, I think we're going to do this, so that means I'll buy the dip. If you do that, you have to give yourself you have to understand a couple things, and we're going to get into those things. And one of those things is that, like, averaging down, like, is a literal dangerous game. Here's an example of Labu. So for whatever reason, I honed in on this stock somewhere back in here, okay? And I was like, yeah, dude, this is going to be great, you know, when we get the rebound in the markets, because I think the market's going to go back up, right, at some point. Labu is going to be a beast. It's a 3x bull ETF on the biotech sector. It's going to be nuts. It's going to be awesome. And so the story kind of goes, I'm kind of honing in. I might start buying some, you know, go back to you can even go back to the past videos. It's all here. I don't fucking hide shit. It's all up on the channel. Like, you can go back and look. You know, I'm not going to take the video down. I haven't taken the fucking video down. Literally, maybe I took a video or two down, or some videos down from like 5 years ago that just like made no sense, or I just didn't like, or were stupid because there was, you know, new information that came out that like made those irrelevant, or like made what I said like literally wrong, and it has nothing to do with the stock market. It could be like, I don't even know what I was talking about back then, or what videos I was making. But anything of the past couple years, I have never touched. I have never taken a video down. Just never done it. So I start buying the dip. Okay? And for whatever reason in my head, I was buying this dip in the spring of last year. And I had some time horizon, some arbitrary time horizon of June. All I remember was buying June expiration Labu calls, out of the money calls, some in the money, mostly out of the money calls, that essentially went to zero. Like, they literally went to zero. But what the problem that I had was that I had a position and I was averaging down, averaging down, averaging down. We would get, if you average down properly, or if you average down at like a good time, for example, if I bought here, right? We got a couple weeks of a push up, like the options would do very, very well. But the problem was that I hadn't traded this enough, or I also just was trading something with the intention or with this thought process in the back of my head that the market's going to go up, and I didn't really think that I was going to be wrong on that. Dumb, right? But that was me a year ago, right? Think back. And, you know, now I don't care where the market goes, to be honest. You know, next month, you know, I kind of just play off the technicals that I see now and the patterns I see now and what I see in the news and whatever, but that's it. But when you do this, right, you get into trouble because you have no concept of risk. And I think it goes hand in hand with averaging down. But the thing is, you average down because you think you're going to be right. And so when you're playing options and you're just averaging down without some sort of risk parameter, like, hey, I'm going to only put in $2,000 of a portfolio that's $20,000 into this position, because if I am wrong, I don't want to keep funneling thousands and thousands of dollars into this and lose more and more and more. Now, if I recall correctly, I did end up making a few bucks. I lost a lot of money on Labu on the way down. I made some money back on the way back up because it did bounce back nicely. But the concept here, or the idea, is that it was so stupid because I could have completely eliminated some of these losses, or at least not all of them. But if I was wrong, I could have made the losses so much smaller and maybe taken myself from losing that 16 down to 15 or $14,000 just because of this one mistake, right? So that's the idea. You gotta have some sort of risk management. If, let's say, we break a new low, I'm out. Or let's say, you know, I'm willing to risk 20%, or I'm willing to risk 50% on this position to make 100 to 200% on the options, because options can do that, then that's fine. But you have to have a plan, and you can't go in blind. And that's what I did, right, back then. And looking back, what's happened since, I mean, yeah, you had this period of time, but outside of that, what's it done? Nothing. Right now it's actually looking like shit again, so it doesn't look good. And so again, maybe the rebound comes really, really nicely, but again, when you're playing options, averaging down like that is a dangerous game, okay? Number 2, options are fucking hard. Options on 3x ETFs are nearly impossible, okay? Now, I say impossible, it's not. It really is. They're harder. Why do I say that? Because you're fighting 2 battles, okay? Theta decay on the option, so time decay on the option contract that you are trading, okay? Like, as we get closer to the expiration, it's losing extrinsic value. It's got intrinsic value, and if you're playing out of the money contracts, you've got like no value, right? They're closer and closer to expiration date. But the second battle is that there's also decay on a 3x or a leveraged ETF. So you play Labu, and I'm here, and I may as well kind of talk about it, right? It's a 3x biotech. But the thing is, if it flatlines or goes down, we're actually getting hurt more than you think, right? And this can just, if we just chop around up and down for a couple of weeks, this will look a lot worse. So for example, this stock will actually do a lot worse if it's going against you or just chopping, right? So XBI is the actual biotech ETF. Now notice XBI. XBI is sitting here at around $74. The lows around $62 that we had back in 2022. Okay, see how far off? It's got a decent amount of range, right, to go until the lows, right? Yet if I were to go back to Labu almost, it's like right at the lows. It's like within a day or two of downside, and we're at new lows, right? And that's because what happened in here, okay? Massive decay. And also, it's a bullish ETF. When we're moving down, you're getting hurt, and that's compounding against you. When you're going up, it's compounding in your favor, but when it's going down, it's against you. So this could be looked at as like, okay, that's a good thing, or that's just a thing, right? It's a thing to know when you're trading this. Fair, yes, it certainly is. The reason why I say it's harder, nearly impossible, but really it's not. It's just harder, right? Nothing's impossible here. I guess maybe some things, but okay, whatever. Is because now you're fighting a game of the consolidation is actually making you lose money. Consolidation in multiple ways, in the decay of the literal ETF and the decay of the option value, right? And then going against you, you're getting blown out more than you would if it was just the regular ETF or a stock that's, 1-to-1, no leverage, right? So that's why it's harder. So I'm like, okay, what do you do? Well, you got to size small on these because they could be, 2, 3, 4, 500% winners if you're right, but they can also be that 95% loser if you're wrong. So again, the risk reward is fine. I found that you're going to probably lose more than you win on these because of all the things you're fighting against, okay? But if you can win with multiple 100% gainers and then have those 90% losers, like you could still have a profitable system with that. It just has to be something you're aware of and take into account before you go deeper into it. Now, gets me to number 3. I don't know why I did this. Number all these hand signals. Number 3, okay? Number 3 is time is not on your side, okay? Obviously, we kind of just covered that with options, right? Time is ticking every time, like every minute, every day that this option position is open, you're bleeding out potentially if it's not moving nicely in your favor, okay? So you get down to this point of breakout versus dip buy. And to be honest, I'm someone who just over the past year, I just didn't like the breakout trade because I'm like, hey, well, the risk reward sucks compared to what you could get on a dip buy. Not necessarily, in my opinion, now, after thinking about it when it comes to options. Because would you rather be, for example, I'll look at NVIDIA nowadays, right? Would I rather be trading NVIDIA these past couple of weeks, right, when it's been pushing up, or on the long side, or would I have rather been trying to kind of average down and buy the dip in here? The thing is, when you're buying a dip, you're going against the grain, right? And so you don't really have a good feel for the timing. When you're playing the breakout, like you're expecting momentum to continue. It's got to continue. If it's not continuing and it breaks down, you get out, you move on because you're wrong, right? Momentum stopped, it died, your plan, your setup, your breakout's no longer working, get out, right? When you're buying the dip, it's a little bit easier to kind of mentally, average down, like lesson number 1, right? And kind of mess with yourself a bit more. And then, you get times against you and things get a little more difficult, right? So I personally now, I honestly think that the breakout trade on options is actually maybe something that I don't know, underutilized or I didn't give enough thought to, because I think that that's probably where you'd want to be. And it could be up or down, right? Breakout to the upside, breaking down below support to the downside, because you got the highest momentum state, making new highs, making new lows, breaking a previous high or breaking previous low. Like you've got high momentum. So why not play with that? And then because options, right, time is almost against you, or it is against you, right? You're not going to have to worry as much about like waiting for it to kind of bottom out or top out and reverse. Like you're going that way. It's either going to continue or it's not going to continue. Like that's it. So you got to kind of weigh that. Now that leads me into kind of where I'm at now and what I like to use options for more so now. The day trade side of things, because, you're in for the day. You don't have to worry about picking, expirations that are like, maybe we're going to go up or down in like 6 weeks. So I'll buy a couple months out. Like, I don't have to worry about that, right? It's happening today. I'm going to be out of this position today or not. It doesn't matter. Then on top of that, I took out $10,000 of the Webull account and I put it into Robinhood because I'm like, hey, let's make sure we're not being idiots. Let's just put this into a longer term portfolio, manage it more so from a macro perspective, and use options to make money. How? Sell covered calls. So we like to sell covered calls. You can even sell puts and sell covered calls to cash flow and also to hedge your downside risk. And so that's what I like to do. And I still implement those 3x ETFs, right? Because they have their time and place and they can give you leverage in a sector or just in general in the market. The reason why I like just holding the shares of them is because I'm not fighting 2 battles, I'm just fighting 1 battle. And if I generally get the macro view right, which is more so where I've got a much better feel in my own education, literally went to school for 4 years for fucking what, right? I gotta learn, I took something away from that. I took all the economics classes, like I got a decent fucking handle on that stuff. You just kind of let that kind of cloud you and look at charts and stuff. So you kind of go back and forth. But I let that kind of play. I let those play out, right? From a macro perspective. And also it could be used to hedge. So I can also hedge, upside or downside in the market with a leveraged ETF versus buying puts or calls and trying to kind of say, well, I can maybe go out a month or 3 or 6 or 8. Well, no, I'll buy the leverage ETF. And obviously, if we chop around for 6 months, yeah, that's not going to be great, but I might not expect that to happen. And that's at least a better downside scenario than if I was in an option that was 6 months out and we chop for 6 months and it goes to 0. The leverage ETF, well, it could go to 0. Probably isn't going to go to 0 unless there's a massive move against you. And at that point, your risk management, we're kind of back to lesson 1, like you got to have a cut point. Like when is it no longer working? And you got to have a level to point out and say, yep, I'm fucking done. Like that's it. No, I'm out. Right. So like that's kind of the view. And that's like the thing. You go back. I think I needed to lose the money, because if you didn't lose the money, I wouldn't be where I am now. Is that a good spot or bad spot? You can say, oh, you fucking idiot. You suck ass. You can't do it. I sit here. It doesn't matter. Like I'm 24. I got the rest of my fucking life ahead of me. All these things are going to stack up to be good experiences and lessons that you learn for the future so that you don't make mistakes again, or that you can capitalize at some point in the future in a much bigger way, right? As you kind of build up a bigger portfolio, you have more money as you get older, right? And generally speaking, that's the plan. So I don't know. That's my take. That's my takeaway on all this stuff. Hopefully it's helpful to you. A couple plugs. This platform that we use all the time is TradingView. If you want to check them out, you want to use them, it's literally one of the best charting platforms. It's the best charting platform there is, hands down. I don't think there's anyone that competes anywhere near. Also, you can add in Lux Algo, get some of those automatic indicators up on your charts. If you like the idea of the computer doing all the hard work for you, those links will be up down below. Make sure you are subscribed, thumbs up button, and I will see you guys in a future video. Peace.